Good day to you all. My name is Dr. Obafemi Oyewumi, and I would like to use the opportunity to welcome you once again to a unique class that we're going to be having even right now, talking about a particular subject in cost accounting or management accounting, as the case may be. Today, we are looking at cost, volume, profit analysis. Cost, profit, volume analysis. That's what we are looking at, this particular moment. And I would like to just share my screen so that we can all be part of the class together. All right, just a moment. Just a moment. Here we are. Okay, here we are right now. Let me just put it in presentation mode so that we can all see it boldly. Okay. All right, so we're talking about cost, volume, profit analysis. It is a particular subject in cost accounting or management accounting. It is usually made use of by accountants, by managers, for them to be able to decide, on some areas when it comes to making profit, when it comes to deciding on the type of volume or the number of, activities or the level of activity they have to carry out in order for them to be able to make profit, as the case may be. So here we are right now. Let's just start, the class, proper. All right, so let's just move on. If this is the first time you are joining or watching or seeing this particular video on this particular channel, I would like you to subscribe, to my YouTube channel, or at the same time, make comments, and then as much as possible, again, also share it so that everybody can have an idea of what we're talking about, right now. So let's move on. Cost, volume, profit analysis. Cost volume profit is a management accounting tool that expresses the relationship between, cost, volume, and profit. Now, when it comes to the cost, when it comes to producing goods and selling goods, every organization desires to make profit. All right, so there's a relationship, there's a connection between the cost of production, okay, and the volume of sales, and of course the profit that comes, from the volume, when it's being sold. So today that's our focus. We are looking at this relationship because it connotes a lot, it speaks a lot, it speaks volume, as a matter of fact, so that we enable management to make certain critical decisions as per whether to actually do some project or go ahead and, execute a particular project or otherwise. So it represents an application of management costing or marginal costing that seeks to study the relation between cost, volume, and profit at different levels of activity. Okay, it can be relied upon when it comes to short, term planning and decision making. It's a managerial accounting method. Okay, it talks about, how changes in volume, how changes in sales, or how changes in costs, okay, or selling price can affect the operating profit of a particular organization. So let's move ahead to talk about, it further. The questions that this particular topic answers. Number one, we talk about determining the break-even point in units of an organization. It can also say, speaks to, the idea of actually determining the break-even revenue of an organization, or how much does an organization earn when it comes to achieving a particular, budgeted profit, or how much, how many goods, how many units must be sold for a particular target to be reached or to be met. So those are the decisions that will have to be, that have to be taken in most cases by management in order for them to, produce, or of course maybe buy and sell, some of their goods that they sell. What level of price change affects, the achievement of a budgeted profit, or what is the effect of cost changes on the profitability of an operation. So these are the questions that this particular subject will help us to address, even as we continue in this particular discourse. Okay, so let's look at the objectives. Let us look at the objectives of cost volume profit analysis. What are the objectives? Number one objective is that it helps to forecast profit, in as much as possible. That the desire to, that's the organizers now, that's the organization or the management, whatever they desire to achieve, it helps them to forecast profit accurately. Okay, it's of course, it helps them to set up what is called flexible budget. So you can know what your budget is like when you set 10 units, when you set, for example, 100 units, when you set 100, when you set 200, when you set 500 units, that's if that's the level I want to begin to operate on, what you're going to set as, budget. Okay, it helps you to set up a flexible budget. Something that it's not just static one that you have only one level of operation, and that is what you rely on. That's what you work, with as a budget. No, it helps to do several. Okay, we have flexible, budget. Of course, cost volume profit analysis also assists in evaluating performance for the purpose of control. It helps evaluate performance. So that's also, another thing that it does. Such analysis may assist management in formulating pricing policies by projecting the effect of different price structures on cost and profit. So you know that at every level, there are different categories of cost, and of course, different levels of achievement, different levels of cost that you're going to incur. So cost volume profit helps management to actually formulate pricing when it comes to different levels of operation. So let's look at one key area that will also fast track, also help this analysis, proper, and that is called the break-even analysis. Break-even analysis. So what is break-even analysis? I put it as B/E. Break-even analysis is the major element of cost volume profit. Okay, cost volume profit. It defines a position where total cost will equal total revenue. At that point, there is no profit, there is no loss. Break-even analysis, that's what it speaks to. It tells you the point that you reach where there will be no loss and there will be no profit. Okay, it's a cost, it's a level that you reach where when total cost also equals total revenue. That's break even. Okay, that's when it said that the company has broken, even. Okay, the concept of break-even analysis relies heavily on the application of behavioral cost classification of cost. Behavioral classification of cost. When we talk about behavior, we talk about the fixed cost, we talk about the variable cost. So we said that fixed cost is, remain static at a particular level of operation. Okay, and of course, variable will also move. We likely move with your cost, units that you produce, per time. Okay, so what is break-even point? It is the volume of sales or production where there is neither profit nor loss. Thus, we can say that contribution equals fixed cost. So that's what we're going to be discussing, from now on. What are the assumptions of break-even analysis? Number one, there will be no uncertainty. Everything is certain. That's the first assumption. Number two, total cost can be accurately divided into fixed and variable components. Fixed and variable cost. We talk about behavioral concepts the other time. Okay, talking about you as an individual, as an accountant, as a management accountant, as you can actually break your cost into fixed and of course variable components. Number three, the only factor affecting revenue and cost is the activity level. So activity level is the one that will actually, affect your total revenue or cost. Number four, the fixed cost will remain constant within the relevant range, and that is true. Fixed cost will remain constant at a relevant age. When you move to another level, another range, fixed cost can go up. But of course, at a particular range, the fixed cost remains, constant. There are no stock level changes or stock value or stock at value at marginal cost only. Number 6, profit is calculated on marginal or variable cost to the fixed cost. Number 7, there's a linear relationship. There's a direct relationship between revenue and cost. That's what it means there. The analysis of CVP relates to a single product or constant mix, constant sales mix. Methods of production, level of technology, and efficiency remain unchanged. Okay, it remains unchanged. The behavior of revenue and cost is linear, so it has a direct, it's a straight line relationship between the two, revenue and cost. And then the unit price, unit variable cost, and the fixed cost are constant. These are the assumptions of break-even, analysis. Let us look at some of the relationships as we just continue. The first one is that sales minus cost equals profit, and that's correct. Sales minus total cost. So when you have your sales on one side and you have total cost on one side, the result when you deduct total cost from sales is your profit. All right. So total cost here means variable and fixed cost. That's what we broke it down here. Total cost means variable cost and fixed cost. So invariably, if you want to enlarge this particular, formula, what do? We just say sales minus, in bracket now, in parentheses, variable cost, plus fixed cost. So variable cost plus fixed cost equals profit. So that's what we are trying to break it down as much as possible. Other ways to also explain this is to say sales minus variable cost minus fixed cost will also give you profit. So these are the different, elements that we have to consider as we look at this particular topic. Now, when we need to look at other definitions, talking about relation between cost and profit, we're saying again that your sales minus variable cost will equal what? Contribution. Will equal contribution. So that means that when you have your contribution minus fixed cost, is also going to give you your profit. And so contribution equals profit plus fixed cost. Profit plus fixed cost. So you can see the different, the combination of different elements that were added together here just to buttress, or just to outline the different factors affecting different factors, relating to cost, relating to profit, and relates to sales. That's what we have here. Talking about from sales to total cost. Sales minus total cost equals profit, and then your total cost, when you break it down, you have variable cost plus fixed cost, and then we're still expressing it the same in a different language. That's sales minus variable cost plus fixed cost will also give you profit. And of course, when you have your sales minus variable cost, which invariably, is your contribution, just like we have here, minus fixed cost will also give you, profit. All right. So contribution now minus fixed cost will give you profit. Contribution equals profit plus fixed cost. So when you interchange, you also have this same, formula the way it is. Okay. So let's just move on to look at the application of break-even analysis. What do we apply? So now for us to arrive at a break-even point in units, we can have break-even point in unit and break-even point in value. That's the sales value. Okay, so your break-even point in units, you have fixed cost divided by contribution per unit. Contribution per unit. And then when you want to look at your break-even point in naira terms or sales in value terms, you want to talk about break-even unit point, as per unit multiplied by the selling price. That will give you your break-even point, using arriving at the value of your break-even point. Let's look at other determining factors. Now, determination of level of sales in units. When you are, it's possible for management to say, I want to know how many units of goods I have to sell in order for me to break even, or in order for me, to exceed my break even limit. Okay, so you have been able to itemized, you've been able to define your break-even unit, but then you want to now say that if I want to achieve a particular, a desired profit, how many units of goods will I sell still? So you have here your fixed cost now plus your desired, profit, that's profit before tax divided by contribution per unit. Okay, contribution per unit. Now, another point you have to consider is peradventure, you're only giving, you know the profit after tax. Profit after tax. Okay, this time around, maybe you don't have the profit before tax, you have profit after tax. You have to, go back and find a way to, work with your profit after tax to arrive at the original profit before tax. And how do you do that? It is to divide, your profit after tax by 1 minus the tax rate. So, and when you divide by, the contribution per unit, you'll be able to arrive at the number of units to be, sold in order for you to achieve your determined, profit, your determined profits. Let's look at some examples here so that we'll be able to appreciate what we're talking about, today. A company sells, illustration 1, a company sells one product with the following information. Take note of this. A company sells one product with the following information. Selling price per unit is 120. Variable cost per unit is 70 naira. Fixed cost, is 250,000 naira. How do we determine our break-even point? How do we determine our break-even point in units? What should we do? First, you need to know the contribution value, the contribution amount, the contribution margin. And like we defined earlier on in the time past, we talk about our contribution being what? Okay, we said our contribution is, if we look at this, what we have here, sales minus variable cost. That's our contribution. So going by what we have been given here, we can actually determine our contribution. So what's our contribution? Selling price minus variable cost. That's 120 naira minus 70 naira, and then that will give you 50 naira per unit. Okay, once you know your contribution, then the next thing is to also calculate your break-even point. Calculate the break-even point in units. So all you have to do is to divide the fixed cost by the contribution per unit. We know the contribution per unit is 50 naira, and then our fixed cost is 250,000. So what will you get? It is 5,000 units. So it means that the company must sell 5,000 units to cover all its costs. The company must sell 5,000 units to be able to cover all the costs, in producing, this particular product. Okay, so at that point, it means that once you sell at 5,000, when you sell your 5,000 units at the rate of 120, you are breaking even. You are not making any loss. You are not making any profit. All right. That's what it means. Okay. That's what it means. So now we have been able to calculate the break-even point when it comes to unit. Let us look at break-even point when it comes to naira, when it comes to value. Okay, sales value. All right. We have two methods basically. The first one, this is what you're going to arrive at. Since you already know the break-even point per unit, all you have to do is to multiply the selling price by the break-even point per unit, and that will give you 600,000 naira, as the case may be, whether naira or dollar or pound sterling or whatever. So that will give you 600,000 naira. So you need to just, once we've identified our break-even unit, so for you to know your break-even point in naira terms in value, then it means that you have to multiply the selling price by the number of break-even points and units that you've arrived at. So that will give you 600,000 naira. Okay. Now the second point, if you want to look at the second point, the second method is determining what is called contribution, margin ratio. Contribution margin ratio. How do we arrive at our contribution margin ratio, which we know as CFR in unit? We already have it unit here, and of course, we want to also have it in sales. We also have it there. So this is the ratio of contribution to a particular sales value. Contribution to a particular sales value. So what do we have here? This is selling price minus variable cost. That was contribution. So all you want to do is the contribution to the sales value. So you have selling price minus variable cost per unit divided by selling price. That will give you your CMR. If you want to look at it in Naira terms, value terms, what do? You deduct total variable cost from your total sales and then divide by total sales. That will also give you your CMR. That will also give you your CMR at the end of the day. I believe you are following this particular discourse, as I've been talking. All right. So it is very simple, simple logic for you to be able to say, okay, this is what I have to do in order for us to get this particular thing. Let's look at another illustration, here now, what I call illustration 3. This time around, we're using the CMR concept, So for us to know the break-even point in Naira terms, in value, okay, what do we do? Pre-pieces value, we have the fixed cost divided by contribution margin ratio. Contribution margin ratio. And you remember, a contribution margin ratio speaks to this: selling price minus variable cost per unit divided by selling price. So what do we have here? We have 120, okay, as our selling price minus what? 70, okay, and that will give us 120. So this is the ratio. This in now expressed in decimal, expressed in decimal points. Okay, so we have 4.166666 like that, or maybe approximately 4.42. Okay, so that's what we have. So what do you now do in order for you to arrive at your break-even point using in Naira terms now? So what do you do? Break-even point sales value 250 divided by your CMR. This is your CMR now. Just the CMR. So 250, that's the fixed cost, what we have here as our original formula. Fixed cost divided by contribution margin ratio. So 250 divided by 0.41666, that will also give you a 600,000 Naira, which we earlier arrived at when we multiplied it by the selling price. When we multiply the cost price, the break-even in units by the selling price. So we also arrive at the same thing. You can see that we have been able to arrive at the same thing right now using price multiply, using price, the selling price multiplied by the units produced, I mean the break-even units, okay, and then we also use fixed cost over your contribution margin ratio. So that's basically what this will also give to us. Same figure is what we're arriving at. Now let's go further. Suppose a company wants to arrive at a particular target, or a target, profit, to say, okay, I want to know what the number of units that I have to sell in order for me to arrive at a target, a particular profit. What must I now do? You can also use your CVP, okay, and using your break-even point, analysis to arrive at that. So here we said, let's assume that all the initial details, remain the same. I would say, suppose the company wants to earn a profit of 100,000, earns a profit of 100,000. Okay, remember what we started from? Where we started from, we started to talk about a company, okay, having to sell a product at 120, the variable cost is 70, and then the fixed cost is 250. No mention of profit here. No mention of profit here. Now we are bringing in a new concept to say, if I have to sell and I want to make a particular profit, how many units of the same goods will I have to sell? All things being equal. How many units of products will I have to sell? I will say, suppose the company wants to earn a profit of 100,000. So what must the company do in order for him to know, or the management to know, the number of units to sell, for them to make the profit of 100,000? All it is to add the desired profit, okay, the target profit, to the fixed cost and divide by contribution. That's what it takes. Add the whatever it is that you desire to achieve, 200,000, 500,000, 5 million, add it to your fixed cost and then divide it by the contribution. The contribution is constant because we are selling at 120 and then the variable cost is 70. Remember, we're looking at variable cost, okay? So fixed cost plus targeted profit, that's 250 plus 100,000 will give you 350. So divide 350 by the contribution of 50 naira, okay? Divide this by 50 naira. That's what it means. Please pardon me here. Okay, I used by here. It's supposed to be off 50 naira. So what's the answer? 350 divided by 50 will give you 7,000 units. So the company must sell 7,000 units of the same product to arrive at the profit of 100,000 naira. So that is the way to go about that. Okay, that's the way to go about that. So at the end of the day, you have been able to achieve not just your break-even point. Of course, you'll be able to achieve. You'll be able to, by you sell this, you'll be able to achieve your, your 100,000 naira, profit. And it's very simple. You can do a simple analysis to say, okay, if I'm selling at the rate of 120 and I sell 120, if I multiply 70,000 by 120, and then I incur the cost of 70,000, 70 naira. If I multiply 70 naira by 7,000, and then what will I get at the end of the day? You will see the difference. Okay, you'll see the difference. So that's what we're talking about. Now, I have this as a self-test illustration. That's to be done by you. Okay, to be done by you. We have been going through, the class now for the lecture for the past how many minutes. So I want you to just try this on your Dixon Limited manufactures a single fire detecting machine that sells for 500,000 per unit. The variable cost of production is 200,000 per unit, while the fixed cost is 30 million per annum. So you have to answer these questions. One, the number of units to sell to break even. You already know your contribution now from this. You also know your fixed cost from this. Sales, now this and sales value at break even. Okay, you can either use CMRO or use the point. I'm just trying to, give you, tips, here. How many number of units do I have to sell if I have to achieve a 40 million worth of profit? You can see now that this is just a self-test, thing for you to carry out, for you to do. You can just put your answer in the comment box, as you, after watching this particular video. Let's move on to another concept that speaks to margin of safety. Margin of safety. This is clear. It's simple. What's the meaning of margin of safety? Margin of safety measures, how much must, sales decline to? How much, can sell, or should say decline to, before a business reaches its break-even point? Now, remember in the time, now that shortly, before a while ago, we talked about, you reaching a target profit. So it's possible for a particular company to actually be over and above that same 100,000, maybe 200,000, and all of that. So margin of safety is saying, how much, to what extent must I allow my sales to drop? You're not going to be the one to allow it, but it's just like, okay, taking a management decision. How much must this sale, fall to before I reach my break-even point? So that's what it does. So it measures is a measure used to, margin of safety is a measure used in cost volume profit analysis to show how much actual or expected sales can decline before a business reaches its break-even point. It indicates the cushion or buffer a company has before it starts making losses. So it means that if you goes down to a particular level, it reaches the break-even point. You must not allow it to go beyond that particular level, because once it goes beyond that particular level, then you start making losses. That's what this is speaking to. Okay, so this represents the difference between the break-even point and the budgeted level of activity. That's what is represented. Okay, it is calculated as the difference between the sales or production unit at the selected activity level and the break-even sales or production. So that's what it is telling us. Okay, beyond this level, I must not allow my price to drop. I must not allow my cost to increase, because I'm reaching my break-even point. So that's why you go to some markets, somebody is saying, come and buy at this particular price. Somebody is saying, come and buy at this particular price. They have been able to look at all the cost elements together to say, even if I sell at this price, I will still not make a loss. Okay, I will not make a loss. So for management decisions, it is important for you to know the number of units that you must sell, okay, to get to a particular level of profit. And even after reaching a particular level of profit, the number of units that one way or another you probably will not sell for your profit to go down to break-even point. That's margin of safety. Margin of safety. Okay, margin of safety. And what is margin of safety here? It is basically actual sales unit minus break-even sales unit. So when we talk about actual sales, that's your level right now. And then the break-even unit. Once you know, if your break-even unit is 500, so that means that you must not allow it to go below 500. So if you are selling at 700 today, if you are selling 700 units of that same product, it means that your margin of safety is 200. It's 200. So the difference is what margin of safety is. Actual sales value in other terms now, actual sales value minus break-even sales. That is what it also means. So we can begin to express margin of safety using the following scenarios. Okay. Now let's look at PVA. We talked about price volume ratio. Now sales divided by contribution multiplied by 100%. Then your margin of safety is profit. It equals is profit equals margin of safety multiplied by the profit volume ratio. Okay, when you arrange this properly, it means that your margin of safety is profit divided by what? PV ratio. So if you interplay this, you change the narratives, here and there, it means that your profit, your margin of safety will be profit divided by PV ratio, which is here. All you have to do is to arrive at margin of safety. All you have to do is to bring this and bring it under your profit, and then you have your margin of safety, for a particular product. A large margin of safety indicates the soundness and financial strength of the business. A large margin of safety will determine, and a very small margin of safety will tell you that, hey, you have to watch your cost, you have to watch your sales. Okay, so let's look at margin of safety computation here. All right, let's assume that the company makes a profit of 120,000 naira, and then the PV ratio, that's profit volume ratio, is 40 units, 40% rather, 0.4, 40%. What's the margin of safety? What's the margin that this particular company must reach? What's the level that this company must get to, for the person to determine to say, okay, I am safe with this particular level. So here is margin of safety is your profit divided by your PV ratio, which is what we calculated, we define here, PV ratio. All right, that's what it is. And remember, your PV ratio is sales divided by contribution. Okay, so once you are giving your sales and you know your contribution, you can actually determine your PV ratios. And whenever you can determine your PV ratios, you can actually you also know your margin of safety is very clear. So take note of this, put all these things, somewhere so that you can actually get to understand, it and know how to manipulate these various functions or these various, excuse me, various factors so that you're able to achieve whatever it is that you're asked to do, per time. So in this case now, the business has a margin of safety of 300, meaning that sales could fall by 300 before the company reaches its break-even point. I believe it's clear. Very, very clear. Okay. So this is the amount below, anything more above this one, that means that to go into a loss. We to go into a loss position. And finally, the final note, I said profit equals margin of safety multiplied by PV ratio. And of course, I have to calculate the profit from the margin of safety. Margin of safety must be divided by, equals to PV, profit divided by PV ratio calculates the margin of safety for profit. That's what we just did. Then PV ratio equals profit divided by margin of safety calculates a PV ratio from profit and margin of safety. So these are the variants, the different calculations or computations of formula that you use in order for you to be able to achieve or attain whatever decision that you want to reach, per time. So we have come to the end of this particular lecture. I believe that you have learned one or two things relating to cost, volume, profit analysis, and I believe that by so doing, you should be able to actually interpret whatever results that come from this analysis. You can help your management, you can help your supervisor to make some decisions as the case may be. So thank you very much for being part of the lecture. If you have learned one or two things, why not just hit the subscription, button, subscribe to it, okay, to my YouTube channel, or make one or two comments, answer, or of course ask questions, and then I will come back to also as much as possible answer your questions, or maybe also comment, add my own comments. So whatever it is that you have to say. Thank you very much for watching. God bless you. Bye for now.